Tax break on home loans. Now, although I'm not covering this topic in detail, but I just want to give you some sense around what kind of a tax break do you get on home loan. Now, tax break on a home loan depend on whether the property that you purchase by using this home loan is a self-occupied property or a rented property. What is the difference between the two? Let's say, for example, there is a person who buys the property. He takes a loan from the bank and he starts living in the house himself. Okay? Then it is said that this is a self-occupied property. In that case, generally, again I'm saying generally because at different point in time for different properties, let's say for example the properties which were purchased in 2000-2001, this limit was different. Today it is different. So generally you get a deduction for the interest that you pay on this home loan to the bank to the extent of 150,000 per borrower, which means that if there are two borrowers, let's say both the spouse got together to buy the house, then you can claim 1,50,000 plus 1,50,000 as interest in both the cases. Again, subject to some conditions, genuineness of the case. You can't try to fleece the tax office by just putting these entries like this, right? The other thing can be you take a home loan, you buy a property and you give it out on rent. So when you give it out on rent, you get rental income, okay, which is supposed to be taxed in the hands of the owner. Again, there are detailed conditions as to when, why, what and all those things. That is beyond the subject matter of the present discussion. But if you want to understand it in more details on the tax laws, you can go to our website iedubook.com in the CA student section. We have explained each of these concepts there, right? But when you rent it out, the actual amount of interest that you pay, actual interest, that can be claimed as a deduction subject to certain conditions. Okay, so you can reduce the entire interest here, and normally the rental value as it stands in India is currently very low as compared to the interest that you have to pay on home loans, and therefore this in any case is going to result in a loss. But the good point is that this loss you can adjust against your normal income and pay overall taxes which are less vis-a-vis which you would have otherwise paid. That's some tax planning which a person can look at, right? So these are the two tax breaks. For self-occupied property, generally 1,50,000 per borrower. Rented property, rental income is taxable and the actual interest paid can be claimed as a deduction for tax purposes.